Hi, everybody, and welcome back to video 4 or on chapter 4. And here, when we left off, we're going to explain the purpose, content, preparation, and usefulness of our statement of cash flows. Okay, the purpose. The purpose provides relevant information about cash receipts and cash payments. Emphasis on the word cash. So, where did the cash come from? Here, what was the cash used for, and what was the change in the cash balance? So we break that statement of cash flows into 3 different activities. Operating activities, that's the lion's share of the transactions that we have, and these transactions are generally those that determine net income. So they involve current assets and current liabilities. Investing activities include making and collecting loans, acquiring and disposing of investments, and property, plant, and equipment. These are our long-term assets. And then our financing activities, they involve liability and owner's equity items. These are our equity section and liability section of our long-term liabilities of the balance sheet. Okay, so when we present these, we use this basic format. And in my experience, almost every company does it exactly this way. So we will have several items that are going to tell us our cash flows from operating activities here, investing activities, and financing activities. Then what that will create for this period, a net increase or decrease in cash. We'll start with the beginning cash. We'll add these two together to get cash at the end of the year. Pretty straightforward. Okay, so here's some summaries of that. Our operating activities include the cash receipts of revenues, the cash expenditures, the expenses. Again, current assets, current liabilities, investing activities as shown, and financing activities. And here's our inflows of cash generally here, and then our outflows. When the cash expenditures exceed cash receipts, then we have an outflow of cash. Not good. But we also purchase property, plant, and equipment, maybe purchase some debt and equity securities from other companies, and maybe make a loan to other entities or even to our employees. And then the outflow of cash, here we have our financing activities. We pay some dividends, we redeem some of our debt, we pay it off, and then we maybe reacquire treasury stock, capital stock. Okay, so what do we need to prepare this statement of cash flows? Well, what we need is 3 things. We need our comparative balance sheets, we need a current income statement, and some selected transaction data. So here, to illustrate this, on January 1, 2005, in its first year of operations, Telemarketing Incorporated issues 50,000 shares of $1 par value common stock for $50,000 cash. The company rented its office space, furniture, and telecommunications equipment and performed marketing services throughout the first year. In June 2025, the company purchased land for $15,000, and the following illustration shows the company's comparative balance sheets at beginning and end of 2025. So here, our beginning, here is our ending, or our beginning, and this is our ending, and here's our decrease. So, all right, I'll let you look at that for a second. So now, here is our income statement. We made revenues, we had operating expenses, we had income before tax, in this case, operating income, and we have some income tax. So now we have our net income or profit after tax. You'll note here that dividends are not, I repeat, not included in the income statement. In this case, though, they did pay $14,000 during the year. All right, 4 steps in preparing that. We're going to determine the net cash provided or used in operating activities. This is the key one. We want to make sure, generally speaking, when we're analyzing a company, that we're getting positive cash flow from our core business activities. But also, we can use or provide cash for investing and financing activities. And then we're going to determine the change, the increase or decrease in the cash during the period. And of course, we'll reconcile that change in cash. That ending cash position in the statement of cash flows should tie back to the balance sheet. Okay, let's take a look at operating activities. Here, telemarketing's comparative balance sheet reveals 2 items that are going to affect the computation of net cash provided by operating activities. There was an increase in accounts receivable. So let's go back. Here's an increase of accounts receivable. And what caused that receivable to increase? It was increased because the goods were sold on credit or services were performed on credit or on account, it's sometimes called. Revenues increased and so did net income, but no cash was received. Therefore, we should subtract the $41,000 increase from net income. Okay? And then accounts payable reflects a non-cash increase of $12,000. What caused that to increase? It was increased because various expenses were incurred, but again, no cash was paid. Expenses increased, therefore net income decreased, but the cash was not affected. So we're going to add that $12,000 back to net income. The example I use is if I go to Nordstrom's and I buy myself a shirt for $100, let's say, and what happens to my inventory of shirts? It goes up, right? And so, well, we'll come back to that. And if my inventory goes up, my cash goes down to pay for it, right? So any increase in a current asset, other than cash, of course, means that we're going to subtract that, just like it's shown in number 1 here. But also, the same thing is true for accounts payable. Anything, whatever we do on the left-hand side of the balance sheet, it's the opposite on the right-hand side. So an increase in current liabilities means that we need to add that back to net income. Okay, let's look. So here's our net income. We've adjusted based on an increase to accounts receivable and an increase to accounts payable. And away we go. We got a $10,000 increase in cash from operating activities. All right, now we're going to quickly determine the cash provided or used for investing and financing activities. So we can determine that by looking at the common stock. It increased from 50,000 by issuing those shares of stock for cash. And the company paid $14,000 cash in dividends. So pretty much the journal entries are easy to understand here. Cash went up for the purchase of land. Cash went down for the purchase of land. And here cash went up for issuing common stock. And cash also went down for payment of dividends. They're showing those dividends directly into retained earnings here without doing the closing entry. Okay, so now we can do the cash from investing activities here and the cash from financing activities here. So the net increase of these three items equals 31,000 net increase in cash. Because this was a new company, there was zero beginning cash. And so our end of year cash is 31,000. And if I go back and look at cash, whoops, you'll see that on the balance sheet, that $31,000 is there. Okay. So now we're going to reconcile the change in cash with the beginning and ending cash balance. And as you see, I just did that, just instinctively. The increase in cash of 31,000 here is reported in the statement of cash flow, and it does agree with the increase calculated from the comparative balance sheets. Okay, so let's look at another one. Here, Kaiser Beverage reported the following items in the most recent year, and we get several items here: dividends, increase in receivables, increase in payables, purchase of equipment, depreciation expense, a non-cash expense. You'll remember when we do that depreciation expense, we've already purchased the capital expenditure. So that cash went out long ago. We're just allocating that expense to periods. So our normal entry is going to be a debit to depreciation expense, a credit to accumulated depreciation. So now we're going to compute the net cash provided by operating activities and the net change in cash during the year. So here's our operating activities. We had depreciation expense. We're adding that back because that's a non-cash expense that was subtracted from net income. And so we'll add that back to net income. The increase in accounts receivable, just like before, we subtract that. The increase in accounts payable, just like before, we add that. So the net cash provided by operating activities is 41,000. And away we go. Here, we purchased some equipment for 8,000. That made cash go down. And financing activities, we issued some notes payable. We got cash for that. We paid dividends. Cash went down for that. So the net cash flow from financing activities was 15,000. The difference here between 20 and 5,000, that underscore is missing as it probably should have been. And now the increase in cash from all of these three items here is 48,000. Okay, so in preparing the statement of cash flows, which would be considered an investing activity? Give me a second there. And of course, the answer to that is the sale of equipment. That's our long-term asset. Okay, that looks like a good place for us to stop this video. And when we return, we'll look at significant non-cash activities. Until then, bye for now.